In July of 2020, the world's largest SPAC, Special Purpose Acquisition Company, floated on the New York Stock Exchange. At $4 billion raised, it was unique not just in size, but also in terms of structure. Today we'll be learning about what's new when it comes to SPACs. Hello and welcome to Talks on Law. I'm Joel Cohen. Today we're joined remotely by Pamela Marcogliese and Sebastian Fain of the global law firm Freshfields. Pam, Sebastian, welcome to Talks on Law.
Thanks for having us.
Thanks, Joel. It's really great to be here.
Before we get into the details of what's new or trending in terms of SPACs, let's get a working definition. I've heard them referred to as a blank check company. Sebastian, what does that mean and what is a SPAC?
So a SPAC's a special purpose acquisition vehicle. They raise money in the public markets, so they do an IPO, and they do the IPO with the intent of doing a deal in the future. And that's sometimes why they're called blank check companies, because you're giving the founders essentially a blank check to go and do a deal. And while the sponsors are out looking, the money stays in trust. And if for some reason they don't get a deal done within the prescribed time, normally that's about 24 months these days, then they actually have to return the money to the investors.
Just a basic question. If there's such a great opportunity to invest in something, why not raise then? Why not raise when they have the target in mind?
It's a great question, Joel. And so one way to think about SPACs is actually as a democratization of private equity. So in PE, the private equity sponsor, they don't have deals lined up when they go out and raise funds. They're investment professionals with deal experience and maybe some sector expertise, and they convince investors to commit funds that the sponsor will use to fund a deal in the future. So SPACs generally have the same setup. They've got sponsors which are veteran deal makers or have industry expertise, or sometimes both. We're also seeing a lot of repeat SPAC sponsors. And with strong records of getting deals done. So these sponsors, they raise from the public. Again, it's democratization of public equity. You don't have to be an institutional investor or a pension fund or a family office. Anyone can go and contribute their $10 and get the benefit of these veteran deal makers and hopefully successfully find a deal. And in fact, in some ways, it's better than PE for a small investor, because unlike in PE, if you don't like the deal, you don't have to continue investing. In all the SPACs that are out on the market today, SPACs agree to redeem any shareholder that doesn't want to move forward with the transaction, and they can get their money back.
SPACs, is this something new or just something that's become increasingly popular?
So in fact, SPACs are not new. They've been around for a while. I think that the reason that people are much more focused on them is that they have really increased in prevalence as a result of the dislocation in the markets that we've seen as a result of the pandemic. And so at the very beginning of the pandemic, when the capital markets and frankly the IPO markets fell apart, this really started to seem like an appealing way to go public. And so we saw a number of companies go public this way. And then what we saw is a number of SPACs get raised, and then a number of other companies go public this way. And as a result, I think, of that catalyst, we've just seen an increasing trend in this area.
You mentioned that this is a way for companies to, in a sense, go public. What types of companies make for good targets of SPACs?
Well, I think what we're seeing is that just about any company can be a good target for a SPAC, and the proliferation in SPACs and the increase in the number of areas that they're focused on, I think, really proves that out. I think that we've seen SPACs in a number of sectors, and so I don't think there's really a sector that's not appropriate for doing a SPAC.
You mentioned that there's a number of different sectors, but are there any in particular that have been hot?
Well, we have definitely seen a concentration in the electric vehicle space. So there have been a number of de-SPAC transactions in that area, but I think that we've seen a number of SPACs be raised in the tech sector, in the fintech sector, there are a number of SPACs being done in other areas as well. So we have seen a concentration there, and I think that's a really interesting phenomenon, but I don't think that's indicative of anything, or I don't think it means that other areas aren't equally suitable for a SPAC transaction.
In my intro, I mentioned the size of the recent Tontine SPAC, but the structure of that particular vehicle was also distinct. What was new or different about Tontine?
Tontine was really interesting, and not just because of what it did have, which is Bill Ackman and $4 billion, but also for what it didn't have, which was the sponsor promote shares. So when we spoke about sponsors a little bit ago, the deal makers who create SPACs, what we didn't mention is that in the standard SPAC, those sponsors are very well remunerated. And they get paid well for the risk of setting up a SPAC. So the way it works is they usually put in a small amount of capital, so $25,000 in exchange for 20% of the SPAC's shares. They'll also invest a few $1 million in exchange for warrants, and those warrants can represent up to 25%, or the right to buy 25% of the SPAC shares. So, in a decent sized deal, the return on capital can be quite generous, and it's actually something the SEC has said that they're looking into the disclosure around. One of the many things that Tontine has done differently is to completely get rid of the founder shares. So there's no free common equity anymore, and they struck the warrants a little bit above what they're normally struck at, and more importantly, the warrants have a 3-year runway before they can be exercised. Normally, warrants are exercisable immediately following closing. So here, before Ackman reaps any of the benefits, the company's got to be successful for 3 years.
Interesting. So it sounds like it's much less of a lucrative deal for the sponsors.
Sure. So Tontine is in fact less lucrative up front. But the goal is to attract a much better target. So when you think about the options that a private company has, a SPAC is just one option, right? I mean, they could continue to be private and raise capital privately. They could go public via an IPO. They could try to get acquired by a strategic or private equity, and all come with their own costs and benefits. But the cost of capital is a factor that any counterparty is going to take into account. So if you have many SPACs competing for the same companies as you do right now, and on top of that, the companies have other options, such as private equity, you would expect that a SPAC with a lower cost of capital like Tontine, which did that by eliminating the founders' warrants, is going to be more attractive. Tontine, for example, in its IPO prospectus, said it was seeking a mature unicorn. So if it comes away with a deal for a really great company, then there'll still be significant upside, even without the founder shares.
Given this new structure, how is it impacting the future of other SPACs or the market in general for this type of vehicle?
So I think that what you're seeing that maybe started with the Tontine SPAC is really a maturation of those terms. And because those terms are getting to be a little bit more favorable to targets, as Sebastian mentioned, there is an opening up of the types of and quality of targets that may be considering a SPAC transaction. And so, but not all SPACs are created equal. There's still a really wide variety, but that sort of makes it such that there's really something to consider here. So the SPAC targets can really look around at the SPACs and see if there are economic terms that they'd be willing to consider. And so just recently, you have seen a number of very large, very high profile SPAC transactions. And I think that really is as a result of sort of the more sophisticated nature of the SPACs, the more kind of high-profile nature of some of the sponsors, that frankly, it would have been unthinkable 10 years ago for those kinds of companies to go public via SPAC transaction.
Talking about the future, what do you see for the future of SPACs? You mentioned in your description that this new upward trend in terms of numbers was partly a response to some sluggishness in the capital markets. As direct listings pick up, what do you see that meaning for the future of SPACs? Is this a SPAC bubble, or are they sticking around?
Comparing direct listings and SPACs is actually a really interesting question. In a SPAC, the pricing is largely arrived at bilaterally with the SPAC itself between the SPAC and the target. In a direct listing, as you know, it's really done through the matching of the buy and sell orders as the company lists, and so it does avoid the IPO roadshow.
That's a place where SPACs really do have an advantage over an IPO. So in an IPO, you hire a bunch of bankers and you give them a model and they tell you what they think the valuation is, and then you go on a roadshow where you try to prove it all out, and hopefully the pieces come together and you have a deal. In a SPAC deal, the target negotiates bilaterally with the SPAC to come up with a valuation, just like in any other bilateral M&A deal. And sometimes the market disagrees and the deal has to get renegotiated in order to avoid the redemptions that we spoke about earlier. But you're going to the market with an announced deal and with valuation, and usually with projections that support it, and it allows for more certainty than you get certainly than you get at the start of the beginning of an IPO process.
But there are downsides to these structures as well. So it really depends on what the company is trying to maximize for. And as part of that, I think that, again, the more favorable economic terms on the SPACs will continue to make those compelling alternatives. And so I think the bottom line here is that there's just a lot of optionality, a lot of really good options for companies to consider. And depending what it is that they're trying to maximize for, that'll help direct them towards the option that suits their ultimate goals the best.
Pam, Sebastian, thank you so much for your time and for zooming in with us today.
Thanks, Joel.
Thanks a lot for having us, Joel. It's been really great.
And thank you for watching Talks on Law.